confounded the money markets.
This is Sky News Business, Australia's business channel. The information featured in this program is general in nature and therefore should not be relied upon. Guests appearing on the program may have commercial arrangements with some of the companies mentioned. Before making any investment, insurance or financial planning decisions, you should consult a licensed professional who can advise whether your decision is appropriate for you.
Welcome to Your Money, Your Call Retirement on this Friday evening. I'm Sam Henderson, CEO and Senior Financial Advisor at Henderson Maxwell. Now, we'd love to hear from you tonight, so if you have a question for my expert panel, the number to call is 1300 30 34 35, or you can email us super@skynews.com.au. Apologies for last week's show being on at 7 p.m, so for those of you that were looking forward to calling in, our show was shown at 7 and not 8 o'clock, so sorry about that. We do get a few last-minute programming changes on Sky News Business. Now, joining me tonight on my expert panel is Effie, editor of Money Magazine, and Victoria Mills from victoriamills.com, our business coach. So she's going to be talking to us about goals, objectives, and a number of other angles very shortly. But before we get into it, let's have a look at what's been happening around markets over the last week, and particularly today on the Aussie market. An up day, surprisingly enough. There we go. I thought we might have had a negative day, but plenty of green on screens. Up 24 points is the ASX 200 to 58.14. All odds up 25 to 57.98. Hit that 57.50 and up we go again. Over to blue chips. Let's have a look at what's been happening in your portfolios today. AMP up 11 cents to 6.55. BHP having a great day, up 53 to 32.50. CBA up 5 cents to 88.92. CSL off 97 to 90.01. And NAB up 4 cents at 36.81. Over the page now to QBE off 14 at 13.56. Telstra up 1 at 6.24. Westpac up 27 at 36.73. Wesfarmers off 7 at 43.64. And Woolworths off 48 cents to $29 even. Let's have a look at what's been happening around auction markets over the last week or so. Again, it has been blistering in auctions. Sydney last weekend, 88%. Absolutely unbelievable and an all-time record. Reasonable volumes as well, up over 700 in Sydney, 89.7. That is just huge. Melbourne, 86.6. Over 1,000 auctions last weekend. And again, massive number. Probably the biggest weekend ever in Melbourne that I've ever seen. Brisbane, 41 auctions, 61.5%. Tassie, 1 auction. Congratulations to whoever sold that house. 100% clearance rate. 59.2% in Adelaide and Perth. 17 auction, 19 auctions only, and 42.9. But good results Australia-wide there. Very, very strong property market. We'll be talking a little bit more about that later in the show. But I want to bring Victoria Mills into the show just to talk a little bit about businesses. And you've got some facts for us, some not overly exciting facts, I must say. But talk us through a little bit about what you do first before we get into all of this.
Gosh, what we were saying before we came out, I play in so many what I call large sand pits. I've been doing this for 15 years, so I coach a lot of small to medium-sized businesses, coach executives, coach individuals who are really just wanting to create some change, move some big rocks in their life, but really just kind of get control of whether it's their money or situations at home, just equip them with the skills to move forward. Coaching is awesome. And
what happens in the business happens at home. It's all tied in pretty closely, isn't it?
Yes, so I'm sure you'd find this as well, but I found that clients, you know, their businesses and themselves are very intermeshed. So if they've got some issues going, you know, happening at home, what basically happens is that it gets projected into the business. So when I go into a business, I not only obviously work on a business, but I'm also working on the people internally as well, because their views, their patterns, their thoughts obviously gets carried into the business.
And this comes up in all different angles, doesn't it? And particularly finance. Finance, money, problems with money, arguing over money. Money seems to always come up throughout these processes.
We were mentioning that before as well. Money in terms of stress, it impacts over now 50% of all stress issues in a house is to do with money. And I came across another statistic last week, 75% of single women are now stressed about their financial future because they're not feeling in control or educated around managing their finances.
Talk us through the slide that's on the screen there at the moment.
Yeah,
80% of people don't reach their goals.
I know, aren't these happy facts, Sam? So look, I do like to start with some stats, because it really just shows the reality of where people are at. And so, yeah, 80% of people don't reach their goals. Lots of issues to do with that. I'm going to come back to that one. Most businesses fail within 12 months. Again, failure to plan. 50% of marriages end in divorce. Yes, we know that one. It's a common stat thrown around. The big things that I'm most focused on now is 1 in 5 are now diagnosed with a stress-related mental illness, whether it's anxiety, depression. Obviously, if you've got stress in a business, stress at home, that's going to impact you. And 40% of Australians now who are actually trying to maintain a healthy, balanced lifestyle is causing them stress. So go figure that one.
It's a lot of stress.
And 50% of Australians identifies finances as a cause of stress. And also, which was interesting, I read the other day, 65% of Australians are actually concerned about their retirement, which again comes back to money. And I have a saying, you know, it's better to have more money at the end of your life than life at the end of your money. So it's interesting, yeah. So those stats, yes, whilst they're interesting, it's not, you know, doom and gloom. There is a plan, an action plan out there.
So please tell us what we can do about all of that after those happy statistics.
Don't be a statistic. Look, I'm a big one for being able to outsource. If you have an area where you're not educated around, bring in a professional crew, whether it's a coach or a mentor or a financial planner or someone else who's actually much more experienced in that space to give you the education and the know-how and the skills to actually move forward. And we were talking before that don't let your past failures dictate your future decisions, if that makes sense. So we all have, you know, made mistakes in the past, so don't let that stop you from moving forward and having confidence around moving forward. So learn from your mistakes. And I'm a big one for, if you want to be wise, hang out with wise people or go and employ wise people so you become wise, so therefore you make more knowledgeable decisions.
That's so true. Now talk us through this one, more positive people.
Yeah, so again, just some more statistics on coaching and mentoring. Basically, I'm going to go straight to the end one, and that is 96% of people who've actually gone through coaching and mentoring would actually repeat the process. There's over 70% improvement in their overall work performance. So when I'm going into a business, coaching staff, coaching the CEOs, looking at the infrastructures, eliminating all the stress that is impacting the business, coaching identifies the big roadblocks, but it also puts in strategies to shift the business along. So that's the big thing to be able to understand. It's great to be able to know what's going wrong in the business, but you need to be able to bring in the infrastructure. So coaching overall, or mentoring, or whether it's wealth financial planning, it's about being able to give them the right wisdom to move forward.
You hear a lot of people talking about wanting to work on their business, not just in their business, and you know, getting themselves prepared for retirement is part of this process. You were telling me off camera you work with a couple of dentists, you work with people from all different sides of business, don't you?
I do. So yeah, the dentists, yeah, they're great clients. Again, it doesn't matter whether it's a dentistry or you know, an orthodontist business or a financial planning company or whatever it is. Most businesses have, I'm going to say a very general sweeping statement, but most businesses have common issues. And a lot of that comes down to lack of communication within the management team, and therefore it doesn't actually flow onto the staff. So a lot of the time, the business owners are too busy working in the business and not spending enough time to work on the business, which is where they get caught. Yes, and it's also being able to then set up correct communication spaces to actually get people talking in the business, so the business, everyone knows where the business is actually headed.
So let's go to the solutions. You've got some solutions there. I'm not sure we've got the slides around these ones, but what can people do? What do they need to do to get themselves sorted? Make sure they are going to retire, because a lot of small businesses, they don't put money aside for superannuation. They don't put money aside to repay their mortgages. They're not doing enough to look after themselves. And I always relate it to the presentation in an aeroplane where they tell you to put on your mask first before you put on the mask of those people around you. You've got to look after yourself first, and this is one of the biggest problems, that small business owners don't do it. And there are some provisions for small business owners in Australia to sell their business free of capital gains tax and do all these sorts of things, but that's assuming that their assets are actually worth anything when they stop working. So talk us through your slide here.
Well, look, putting my coaching hat firmly on, it's my top 5 points, which doesn't matter, again, which business we're talking about or which person I'm actually coaching. It's being able to actually be clear on your outcome. So regardless whether you're looking at retiring in 2 years or 3 years or 5 years or 10 years, don't be one of the statistics where you are part of the 65% that has, deep concern about what your retirement looks like. Get in control of it, outsource, what I call your professional crew, get clear on your goals, have clear strategies that are actually going to get you to your outcomes that you set now, so you are in a position to make different choices. Because at the end of the day, you don't want to not have enough wealth when you do decide to sell your business. Clear action steps, being accountable to someone as well. So again, that's the beautiful thing about when you have someone in your corner that's part of a professional team, because you can get a bit lazy when you try and manage things yourself. So again, empower yourself. Get the right knowledge, get the right education, and be continually reviewing your steps, whether it's a daily review or a monthly review, whatever. But just make sure that you're checking in to make sure that your actions are aligned with your outcomes, and you'll get there.
Absolutely. Effie, let's bring you into the conversation. You're sitting there very quietly. I think I've never heard you so quiet, to be honest.
I'm just thinking I do get stressed when I go to the dentist, but that's because I get the bill. So I'm on the other end there. Yeah.
Don't we all? But a lot of people have to use their work, their employment, whether they're employed by someone or running their own business, particularly small businesses. They don't look after themselves. They need to do more of that. What do you reckon?
Well, the problem with small businesses, obviously, is their cash flow. And it's easy for us to sit here and say, yeah, there are lots of tax benefits and reasons why you should be doing this, and setting up your own super fund and so on. But it is the cash flow. It's that cash flow problem. And as you said, businesses, failing within the first year is high. But it comes down to, what was interesting, your steps can apply, and they should apply really to everything. Whether you're doing a financial plan, I guess, or your business, it is your clear goals. It's sitting down there and getting clear goals. And I'm a great believer also of outsourcing. If you don't know it, go get help. See a financial advisor. It was interesting, I was reading some, and this is stats in the US, and I'm sure you're going to love this one. Vanguard in the US came out and said that if you see a financial advisor, they add on about 3% to your net worth.
Yeah, right.
And look, that's interesting. So they should.
I'd like to think it's a lot higher than that.
Yeah.
But,
on average.
Yeah,
it was an interesting report that came out. I guess the idea of that is outsourcing where you're not good at. So we do have accountants, we do have tax advisors, and in some cases, yes, I can see why this market is growing and has. I guess my question would be, who would be the perfect person to see? Because I'm sitting here thinking, am I too small? Are my problems too small to go see a coach? Do you have to be a business? So it's everyone and anyone.
Look, I've worked with hundreds and hundreds of clients over 15 years. It doesn't actually matter what your issue is. It's coming down to most people, actually all my clients who come to me don't have a clear plan. It's that simple. They are missing the first fundamental, which is you need to be able to be in control and dictate where your life actually wants to be. I'm not saying that you then lose the magic and the flow of, the serendipity of other, gorgeous things happening in your life. But you want to feel empowered along every step of the way. So if you've got a dream or you've got an idea or something that you want to go and execute, or you're not happy in some area of your life, go and get help, because every day that you're actually not taking charge of your life, and I have got lots of great sayings, but if you're feeling disempowered in your world, you will attract people who will actually come in over the top of you and over-empower you.
Yeah, Victoria, unfortunately we do have to go to a break, but how would someone find you if they're looking to use your services?
Just go to victoriamills.com.
Okay, fantastic. Victoria, thank you very much for joining us tonight. Appreciate that. I think small business is such an important part of this great nation of ours. There's hundreds of thousands of small businesses who employ literally millions of people, and it's such an important part about retirement. So thanks for joining us, victoriamills.com. Liam Shorte will be joining us after the break, and remember, every caller tonight will receive a free copy of the one-page financial plan, so do give us a call, 1300 30 34 35, or super@skynews.com.au, and don't forget to join in the conversation. You can sign up for our free e-newsletter at hendersonmaxwell.com.au, or like us on Facebook. We'll be right back after the break.
I want to go to Bangkok. I want to swim under the stars. And then I want the perfect room to feel at home. And when I book, I want it to be for the best price. Can you show me how? Hotel Trivago.
It's true. great wealth is built in the stock market over time. It's also true CoSec stock picks have outperformed the stock market on a consistent basis. See why some of the most wealthy and successful investors have switched to CoSec. Register for your free stock report with insights Michael Kadari reserves for his clients. CoSec, your investment edge.
You know how easy it is to now shop at Mitre 10? That easy. You get great online deals and collect them in store.
Easy to install wall panel heater, $79.
At mitre10.com.au.
Which country do you think was responsible for these important inventions? You might be surprised to know that they were all in some way born here in Australia. The latest intergenerational report underlines that the best of the mining boom is now behind us. So can our Aussie knack for innovation help fuel new economic growth?
To see this talk in full and to form your own view, search Challenge of Change. Authorised by the Australian Government, Canberra.
Let's go again. Don't do it.
If only everything was as easy as creating your website with Wix. Go to Wix.com today. It's free.
You don't need to be a big business to get the best possible travel rates for your business. You just need to bring an expert on board. A business travel expert dedicated to saving you time and money. At Corporate Traveller, we offer 24/7 service, real savings, flexible payment options and clear reporting. And there's not even a contract to sign. Some business decisions just make good sense, don't they? Corporate Traveller. It makes sense to bring an expert on board.
With just 2 weeks till the budget, many fear it will do little to address the big issues. The Libertarian Senator who's demanding an urgent return to surplus. But is this the fiscal medicine we need? Join me.
Welcome back to Your Money, Your Call Retirement. Keeping me company now is Effie Zaras, editor of Money Magazine, and Liam Shorte, director of financial planning firm and SMSF specialist Veronte. Now, if you have a question for us tonight, do give us a call. We'd love to hear from you. 1300 30 34 35 is the number to call, or you can email us super@skynews.com.au, and every caller will receive a free copy of my book, The One-Page Financial Plan, so don't be shy. Give us a call. Love to hear from you. Now, I'm going to bring Effie into the conversation now. Effie, we have the cover of Money Mag, which we'll put up for you now, but talk us through this month's Money Magazine. What can we expect to see?
Well, I hope this month hits the mark. Again, it's focusing on where you should be investing. I mean, with interest rates still, ridiculously low, they're going to be low for a while. I mean, the share market's had some, it's a good run, has fallen a little bit back. Sure, there's lots of opportunities. Answer the question, where would you be investing? And if you had, say, $5,000, the power of $5,000, you don't need a lot of cash to actually get rich, so to speak. You just need a good investment strategy and build up slowly, slowly. So we look at several ways. I think we've got about 15 ways that you can invest $5,000.
Returns of 16%.
I know.
Where do I go?
And these are, look, of course, I need to say past performance is no indication of future performance, nor should you look at past performance as a way
Disclaimer, thank you.
But, I mean, these are really good, solid investment strategies that would work equally well with $100,000 or $5,000. And so we look at your traditional areas, shares, ETFs. I mean, ETFs have done really, really well. You could be tracking the ASX 200 for as little as, say, 0.24% as far as fees go. We have a look at some managed funds that have performed extremely well, Perpetual being one of them. That has grew to, achieve returns of some of them up to 11 to 16, as I said.
Is that their Aussie share fund or their industrial share fund?
That particular one is their industrial share fund.
Industrial share fund,
which has done very well, very well.
So more resources exposure. So
it is, and we do look at active versus passive. I mean, when you're looking at small caps, managed funds have really outperformed ETFs in that area. So it doesn't automatically mean go for a cheap ETF. I mean, there is a place still for active, Well,
it's a good point. There was a good point made this week by a superannuation analysis company that said the same thing. Cheapest is not always the best.
Yes,
and in fact, cheapest was definitely not always the best. So it's very interesting that people are very very focused on fees, yet, you know, as I always say, price is what you pay, value is what you get.
It's your net return that you've got to look at, and that's been an interesting exercise. And we also look at some alternative ways to get, you know, a return. This is a lot more riskier, and you know, we make it very clear that it is riskier. Peer-to-peer lending. You know, there is one player out there now that has it out there for the retail investor, and actually one of our journalists has invested some money herself in there, 10% return. Now you can imagine who's borrowing that money if the cash rate's at that amount. But look, it's an interesting model. It's been going in the US and UK for ages. They have yet to lose anybody's money on it, but I'm putting it out there. It is risky. It's another way of getting a return. So there are other, you know, options as well. And we look at collectibles. We look at putting it back into your business. We look at putting it into your super. Simple as, if you've paid all your debts, what will $5,000 do to your super fund? Well, for someone at my age, it could easily add on another $30,000 to $40,000 by the time I retire.
Easily.
So.
You're so young, of course, so by the compounding effect, it would take forever.
I think I did give myself a couple of extra years.
Yeah, absolutely. Liam, we always talk as advisors about the compounding effect of money, but, you know, the value of $5,000, I mean, a lot of retirees can make a lot to do with $5,000, can't they?
Yeah, look, it's just a matter of getting it working for you, not just leaving it sitting there. But what we're seeing at the moment is a lot of people shoving it into the market after the market's gone up for 3 years. So you've got to be careful about choosing your timing. And for younger people, I still see younger people in their 20s choosing the balanced option in their superannuation funds. There's 50 years before they can touch the money.
Not to mention all the changes to superannuation between now and when they actually
get it into a high growth option, or even get it into a geared share fund and let it work for 50 years. I can guarantee over that period, gearing is going to work.
Yeah, absolutely. Let's hope so anyway. We're in a lot of trouble if it doesn't. Now, data from the ATO this week helped with missing context matters with their latest round of statistics on the popular investment strategy of negative gearing. Statistics indicate that in spite of popular perception, the strategy is a tool of the wealthy investors. The highest number of property investors are middle income earners with a taxable income stream between $37,000 and $80,000 a year. Furthermore, with interest rates declining and rents going up, negative gearing's impact on the tax system has actually declined by $2.4 billion or 31%. So, Effie, what do you think about this one? Negative gearing less effective when interest rates are low?
It is. I mean, that was an interesting report. I think the income there that they showed didn't factor in that that's after the tax benefits have happened. So they're not as poor as, you know, they're crying. I still believe it is definitely, you know, the top income earners, and it benefits them, negative gearing. It is a hot potato. It is on for discussion. Where do I sit with it? I actually could see negative gearing going, I think.
Really?
I think I might.
Do you have an investment property?
I do. I do, and that is really going against.
You happy to give it up?
No, I'm not. I'm not. But looking at it from the argument point of view, it's a hard one. It is a hard one. It does benefit the top income earners. So if I'm arguing for home loan affordability, I don't think it's helping it. I don't think it's making it any easier for first home buyers. So no, I don't agree negative gearing should be in there to support that because it's not working. As a way to build investment wealth, yeah, of course I support it.
As far as, I was on another channel last night talking about affordable housing, and in my mind, I don't actually get that argument that negative gearing doesn't help it, because essentially it allows people to buy property from developers if that land is released by councils and state governments to allow greater levels of housing and probably cheaper housing because there's going to be more supply. So it's simple supply and demand. So I don't actually get that. I think it comes down to state governments releasing more land around those sorts of things. So I don't really get that. I think we should have things like negative gearing to incentivise people to go out and invest their money.
But if you need to target negative gearing, I think, in the future.
Agreed.
Yep. You're going to
Happy to do that.
Stage the phase out of it on existing properties, promote it on new properties. But at the same time, you've got to have state governments releasing more land, or you've got to get people getting realistic and going into medium density.
So, Liam, you're saying on new properties. I agree. I agree on that. It needs to be targeted. And the thing is, when you go to an auction, you've got an investor and a first-home buyer. At the moment, the investor's going to win it all the time. Take negative gearing away, the investor can't afford it. Hopefully, the first-home buyer can get in. So I don't see, you know, we're going to be any worse off. I really believe exactly it needs to be targeted.
But you can't have major shocks to the system. They've tried it before.
It's a political nightmare, no.
Whatever they do, stage it in, target it, and make sure that at the same time you're promoting growth of the economy.
Absolutely. Have you looked at NRAS properties, the National Rental Affordability Scheme?
I have, and I do get asked that a lot. I mean, obviously you've got your tax benefits there. The thing I worry about that only is be careful where you're buying and where it is, because if you are looking for capital growth, I think that's what it's lacking there. But it's an interesting scheme, and there are a lot of investors in there. It does suit, I think, the way it works with self-managed super funds, because the regular income that comes through. If I was an investor, I'd be very, interested, and do your research well as to where is that property, because if you don't have that rental, the yield coming through, I'm not sure how they're fed by capital growth.
And be very careful about the promoter that you're using, or the developer.
Oh, absolutely.
Because the NRAS scheme has been stopped now, a lot of them are going to lose interest and they'll move on to something else. You're tied in for 10 years. Into the agreement to get the deductions, so you
exactly
be
right.
very, very careful.
Yeah. Now, on a different note, let's go to a viewer email. Peter writes, should the younger generation put money outside of super, considering there's more and more experts telling us we should not be able to get a lump sum payment in the future? Peter, this is a really good question, and I would actually agree, but let's go to my experts first and get their opinion. What do you reckon, Effie?
Well, I'm not a financial advisor, but I would agree with that. I think you should diversify your investments, and I wouldn't put all my eggs in one basket, so to speak, pardon the pun. Super is just one investment vehicle. And look, they've increased the age pension. If they change legislation as to when you can get your super out, you really are stuck for cash flow, and you are forced to wait to that retirement. If you have investments elsewhere, then you are in control as to when you can draw it and what you want. And let's face it, super keeps changing. That could very well happen.
What do you actually think about the government legislating that you can't take your own money if you need it?
Very angry.
Yeah.
But I can understand why too, because if you're running a business, you would be worried that everyone's going to, grab it out, go overseas, blow it away, come back and cry poor.
Well, that's certainly what the industry super funds have a problem about. In my opinion, it's purely about getting a run on the money, which I think is a terrible state of affairs. But in terms of them wanting to legislate against it, what do you reckon, Liam?
Yeah, look, as far as the lump sums, I see too many people that have very little in super, and all they do is take it out at 65 and blow it.
Yep.
And then they go, oh, but we'll live on the age pension. Yeah. The age pension is not a comfortable thing to live on. It's $33,000 for a married couple. It's not
23 for a single. Yeah, it's not much, is it?
But on the actual, investing outside of super, what all becomes new, what we're looking at again now for people, especially the higher income earners, is looking at insurance bonds. So basically, if they're going to be investing for 10 or 15 years before they touch the money, using an insurance bond, it's taxed internally at 30% for the first 10 years, and then it's tax-free earnings after that. You combine the two of those with superannuation.
Seems so old school, doesn't it? Old school financial planning, in my opinion, but I agree. But I think people should be able to make decisions about their own money. Now, we do have to go to a short break, but when we return, we'll have plenty more on retirement strategy, superannuation and financial planning, plus your calls and emails. 1300 30 34 35 is the number. Give us a call. We'll speak to you very soon.
I want to go to Bangkok. I want to swim under the stars. And then I want the perfect room to feel at home. And when I book, I want it to be for the best price. Can you show me how? Hotel Trivago.
The digital revolution is coming. Success will come to businesses that can best leverage new technologies. So who should you turn to get it right? CPs are certified ICT professionals independently assessed by the ACS, the Professional Association for ICT in Australia. Technology is high stakes. You wouldn't visit a doctor that wasn't registered. Don't risk the health of your business. Demand the ICT professional you can trust.
Feeling boxed in at work? Think outside the cube at Officeworks. Work without walls with an ultra-thin HP 15.6-inch laptop, only $493. Become more mobile with a Toshiba 1TB portable hard drive with USB 3 for faster file transfer, just $89. And print from anywhere with a Wireless Brother mono laser multifunction, only $229. So think outside the cube and unlock your workspace potential. If you've got the big ideas, Officeworks has the lowest prices.
How do you outperform the stock market on a consistent basis? Obsessed with this idea, Michael Kadari forms COSEC, Kadari Securities. He seeks, in his own words, a revolutionary investment strategy based on better information and knowledge, not tradition. Wealth begins with better knowledge, becomes his motto. He seeks to identify and accurately pick the next top performing stocks on the ASX. He seeks for consistency. Michael Kadari creates a unique stock market filtering system he names Lotus Blue after a flower that blooms just once, because in investing, timing is everything. Now, COSEC's buy picks are so accurate, he introduces 3 of his top performing stocks on national television. As these stocks surge, so does COSEC's success rate. If you want the COSEC investment edge, you know what you have to do. Call COSEC now and take advantage of the insights he reserves for his clients with your free COSEC stock report, or visit cosec.com.au.
You don't need to be a big business to get the best possible travel rates for your business. You just need to bring an expert on board. A business travel expert dedicated to saving you time and money. At Corporate Traveller, we offer 24/7 service, real savings, flexible payment options and clear reporting. And there's not even a contract to sign. Some business decisions just make good sense, don't they? Corporate Traveller. It makes sense to bring an expert on board.
Welcome back to Your Money, Your Call Retirement. Keeping me company tonight is Effie Zaras, editor of Money Magazine, and Liam Shorte, director and financial planner at Shorte Financial Services. Now, if you have a question for us tonight, get in on the conversation, 1300 30 34 35, or you can email us super@skynews.com.au. And every caller will receive a free copy of my best-selling book, The One-Page Financial Plan. So don't be shy. Give us a call. We'd love to hear from you. And just a reminder, our seminars for Melbourne and Brisbane are, in fact, open now, so you can register online for Melbourne and Brisbane. We look forward to seeing you all there. Now, we're going to go straight to an email. Daryl writes, time for a viewer email. Sorry, Daryl writes, what do you think of the fact that the Labor proposal with a 15% tax on super income would kick in with holdings around 1.5 million? Good question, Liam. What do you think?
Look, at some stage, people are going to have to be, they're going to have to stop them putting so much money into super, but it's where you pick that level at
Is 1.5 so much, in inverted commas?
Not anymore. Look, we were just looking at if a couple wanted 70,000 a year, the actuaries worked out that with an 80% certainty, they would need about 1.3 million, so 1.5. But that, of course, that's for an individual. So, that'd be 3 million for a couple, so that is a fairly decent amount. Remembering that outside of super, they could also earn up to $22,000 each or $23,000. So you'd be looking at about 100,000 each before they pay any tax. So I'm not so anti that idea, but the implementation of it across multiple super schemes would be...
That's always been the problem, hasn't it? The administration or the implementation of such a tax scheme would be similar to the old RBL system we had pre-2006, I think it was. It was an absolute mess. Effie, your thoughts?
I agree. That figure surprised me, 1.5, because what we're told we need is it's almost that figure that you need in your super fund. I'll throw this out. I also agree that it's a lot of tax-free income that a whole lot of baby boomers are going to be getting. Is there another way to capture that? Is that the right way to go about? Or should we go back to the drawing board with the GST and have a look at increasing that? Can I throw that on the table?
Well, I think you're spot on. I think the GST...
You capture the baby, that tax-free income.
Exactly.
What you pay for what you use.
And it's a tax on consumption. To me, it seems like a no-brainer.
And it doesn't hurt me if I'm not spending. If I'm not spending, I'm not being penalised. But if you are spending and you've got all that lovely income sitting there, it gets caught back in.
Yeah. 80-year-old pensioner earning $23,000 a year from the pension is not going to be out there buying LED, LCD TVs for $3,500.
No.
And look, the consumption taxes work in most other developed countries. We just seem to have this inability to actually grasp that it can be increased at some stage.
But wouldn't you think it's purely political?
Yeah, well, it is purely...
Which political party is going to go, hey, let's raise it to 15%?
But every other country...
Problem solved, but...
But if you're playing around with these figures, and you're super talking of a tax like this, I think you should at least throw GST and let the people decide.
This is rats and mice stuff, but you're just annoying everybody. You're annoying a third of your voters. So you may as well annoy everybody and do it properly and fix the problem, because this isn't going to fix the problem.
Yeah. And you're right, it's that mindset that the GST was put in, and we all think it shouldn't be increased, but it is a lever that we can can use to try and fix up the deficit.
I think you're spot on. In my opinion, superannuation is by its very definition a concessionally taxed saving structure designed to fund retirement. So people are using it for that. Well, good luck to them. Now, Pauline Vamos from ASFA, the Association of Superannuation Funds, suggested that number should be around about 2.5 million. So I'm not necessarily against having taxes for large account balances, but I think it needs to be a bit higher than 1.5 million. I think it probably needs to be the 2 million pluses, and it needs to kick in at a certain threshold. But again, it's going to come down to the administration. It's going to be an absolute mess. It's probably too hard, and it's really death by 1,000 cuts. So why not increase the GST? I agree with you, Effie, on that one. Now, another email here from Andrew who writes, I've signed a building contract for a new build, and the money is at the moment in a self-managed super fund. What will happen if the government decides overnight that we can't take out lump sums? Interesting question on this one. Liam, what do you think? So he's building a house, but the money is inside superannuation. He's obviously planning on getting it out at some stage, hopefully very soon.
Well, look, I don't think that the government would bring in a rule that would actually be implemented so quickly. I think Joe Hockey and Tony Abbott said numerous times over the last couple of months that they can't affect the people who have put the money into super on the basis of the rules as they stand at the moment. So I would expect if they were going to stop lump sums, they might say anybody who's under 55 now will not be able to get a lump sum at 65 when they retire. So
again, another one of those death by 1,000 cuts. Exactly. It's going to have no income, it's going to annoy a whole bunch of people, and it's going to confuse people about superannuation. So this is just crazy in my opinion. But Effie, what are your thoughts?
Much the same, yeah, much the same. And it leaves little faith into the system, does it, when we start tinkering around with that?
Yeah, absolutely. Yeah. And just to elaborate on this one as well, to get money out of your superannuation, you need to reach a condition of release. Now, that's over the age of 55 and retired, or over the age of 65, whether you're working or not. There are ways to access your superannuation whilst you are still working, or if you're disabled or under financial distress, but they are the main ones. The other way to do it, of course, is through a transition to retirement, so over the 55, under 64, still working, and you can draw between 4 and 10% of your superannuation. And that can also be handy. So hypothetically, if they did change the laws, and they're not going to do it for you on this case, I would suggest to stop you from taking out a lump sum. But if they did, you could actually borrow the money and then use your transition to retirement to pay it off. So there are ways and means around it, but they're probably less than ideal for you, I would suggest. Now, another email here from Hayley. Hayley writes, could it be conceived that the earnings of superannuation funds in retirement phase are taxed as per normal tax on general earnings throughout life? Hayley, I reckon this is highly unlikely simply because of the definition I espoused earlier. The fact that super by its definition is a concessionally taxed saving structure. So therefore it will always need to be lower than normal tax outside. I don't think that will ever change. It's just a matter of maybe introducing some thresholds or getting some tax from higher net worths. But Liam, what do you reckon?
Yeah, look, the whole idea is you're trying to get people to put money away, as I said earlier, for some people for 50 years. No one's going to do that if there isn't a concession attached to it. So yes, like there's always going to be some sort of concession for people, the carrot to make people put it into super.
Yeah, absolutely. Effie?
You'd see a rush of money going out, I can tell you that.
You'd have to, wouldn't you?
You would, because you'd probably find better returns elsewhere.
Well, Leffie, I can tell you there already is a rush of money out.
Yeah.
I've never had so many clients around the 65 age group that are saying, well, how much can we have outside without paying tax?
Yeah.
And they're actually physically taking it out. Even on rumour. So what will happen on fact?
Yes.
It'll be crazy.
Yeah. Now, I just want to have a quick discussion with the panel around the property market, where it looks massively overheated at the moment. But with the prospect of interest rates falling as early as next week, it's possible that we might see more fuel to that fire. 88.9, 88.7, I think it was in Sydney, and similar auction clearance rates down in Melbourne on massive volumes as well. So record-breaking numbers all around. Effie, do you think it can go higher? I mean, is this going to create a massive bubble?
Well, Sydney has just gone ridiculous, hasn't it? In the past year, we've got, I think, over 20% in returns. We actually have covered that in this issue that's coming out on Thursday, and basically we have kind of issued a warning out for the East Coast, Sydney, Melbourne, Brisbane, that, you know, if you are a property investor, you are really buying in an overheated market. Different if you're a homeowner, you've got time on your hand, you do your normal checks and so on. But as an investor, you must be very game to be jumping in and paying these prices because we've got low rates and also yields are falling down too. So it'd be an interesting time. We've got to remember that the average interest rate is around 7.1 and we're down at 4, 5.
Oh,
so
it's ridiculous.
Wait till that turns around, and if you are a highly geared investor, you're in for some trouble.
That being said, I was looking at a one-bedroom apartment in Manly in Sydney's Northern Beaches the other day. For $700,000 would probably rent for around about $650 or so, but the interest on that at 4.5% would only be about $30,000 a year. It still looks relatively attractive on paper, and certainly with or without negative gearing, you add depreciation and you know, maybe some strata fees, but your rent's going to be pretty solid. This is the issue at the moment. Money's so cheap, and it's just pushing up prices. What do you reckon, Liam?
What happens is demand and supply start reacting. I think in Melbourne they've already got a glut of apartments forecast. They're talking about the same in Brisbane. And I read last night there's $10 billion worth of approvals for units in Sydney on the books. And what I'm seeing in the outer suburbs is the reaction to the higher prices. Dual occupancy, granny flats, they're popping up.
It's happening, isn't it?
I know a granny flat builder in Borkham Hills, and they're doing about 12 a month.
It's huge.
Well, when you look at
I'm
the
putting
Sydney
one
market,
in too.
well, look, the Sydney market, I mean, we're very relaxed as far as, you know, building a granny flat. I think it's 450 square metres, 14 or 12 metres frontage, and there you go, 100,000, 120 to put one on there. Immediate depreciation in the first year about $6,000, rent about $300, $400.
I'm hearing people getting $450, $500 a week for these things, so the return on them is absolutely phenomenal.
What we're seeing, and I know it sounds terrible, but there's an inbuilt market for them as well. There's so many single divorced females over 45 that can't afford to get back into the market, but they can afford to rent a beautiful little 2 or 3 bedroom granny flat.
Or the other way.
And they're great tenants.
Putting mum and dad out the back and the kids taking over. It's not going to happen in my house, I can tell you.
I was going to say, have you got some plans in the Zas household?
Not going to happen though, especially when there's only 9-9-year-olds. I refuse to move.
Yeah, for self-managed superannuants, the property market's looking pretty attractive still with those low borrowing rates. People that might have 10 years or more away from retirement. Is it something, Liam, that they should be thinking about?
Look, to buy a property, I have no problem as long as you can get a long-term tenant. The negative gearing inside super is not great, so you know, especially now with the rates so low, it's 15% offset is nothing. So look, it's very much do your research, pick get a property that can be easily rented out, and don't put all your eggs in one basket, because in 5-10 years' time you may have to start paying a pension, and if there's pressure on rental rates, you may not be having enough cash. And the last thing you want to do is sell at the low point of the market.
Yeah, there's no doubt about that. My advice to everyone is think about 7 years ago. Think about 2008, 2009, and whether you could sell your property at that point in time. Always buy for the down times, not the up times. And you know, now is certainly an up time, so probably not the best time to be buying property, but it's still looking pretty cheap. Yeah, absolutely.
And property's probably too. I've been speaking to a lot of experts, and they were saying that if you do, an apartment like you're saying near the beach, close to the city, it's really not going to collapse supposedly. So
I actually thought that was the case, but during the GFC, I remember seeing places in Bondi that were selling at 2.3, selling for 1.3. These were close to 40% discounted to their full price. Unfortunately, like everybody else, I wasn't flush with cash to go out and buy them, but they look pretty good.
You've also got to remember at that stage, interest rates on mortgages were 9.2%.
Yes. Correct.
And people were running out trying to fix in case it went above 10%. And people were panicking. So the market does go in cycles, and you've got to be aware. And because we're 6 years after the GFC, I'm seeing so many people that forgot about it. Well, I'm reminding them time and time again.
Well, most of the Gold Coast, the Sunshine Coast, Portsea, Sorrento, Anglesea, Lorne, Palm Beach, they were all up for sale during the GFC. So if you're rushing in to buy those holiday houses now, just remember what happened a few years ago, because if we do see an oversupply start to kick in the next year or so, as developers suck up this land, we are going to see a bit of a correction in prices, even if interest rates stay stable. Now, we will be returning after the break with more of your questions, so do stick around. 1300 30 34 35 if you're brave enough to give us a call tonight. super@skynews.com.au is the email address. We'd love to hear from you tonight. We'll be right back.
I I found Oscar here on the internet. His breeding is obviously impeccable.
This is my baby. Why wouldn't I pamper her? She's been spoiled her entire life.
Rocco here. He's a winner. I was told his mum was a champion breeder.
Caring about your dog means also caring where they came from. Most puppies bought online or in pet shops are actually from inhumane puppy factories. So adopt your next best friend or visit knowyourbestfriend.com.
Everybody is happy doing what they love doing. We started with one shop and now we have 105 stores across Australia.
Over 10 years, they've grown from a family business to a near corporate style business. Often we discuss what's happening and structure the right loan to help them achieve their business goal.
It's all about customer service, really. That's what I'm looking for in people that I do business with.
See how good relationships lead to great businesses. Watch the series now.
Feeling boxed in at work? Unlock your workspace potential at Officeworks and find everything you need to stay inspired. Visit us today and think outside the cube. If you've got the big ideas, Officeworks has the lowest prices.
Wake up to something special. Moccona.
Guess who just got 60 points on the Amy Safe Driver app, baby?
The current trends in the modelling suggest... Hey Mel, I was trying to...
Amy Comprehensive Car Insurance customers who earn 60 points on Amy Safe Driver app now receive roadside assist free on renewal.
The digital revolution is coming. Success will come to businesses that can best leverage new technologies. So who should you turn to get it right? CPs are certified ICT professionals independently assessed by the ACS, the Professional Association for ICT in Australia. Technology is high stakes. You wouldn't visit a doctor that wasn't registered. Don't risk the health of your business. Demand the ICT professional you can trust.
The Prime Minister says it won't hurt, but the Treasurer says it still needs to. So is this year's federal budget all about sacrificing a surplus for their survival? On the next Cabinet, we'll share our own real-life experiences on Sky News Live.
Welcome back to Your Money, Your Call Retirement. Keeping me company tonight is Effie Zaras, editor of Money Magazine, and Liam Shorte, director at Veronte Financial Planning. Now, if you do have a question for us tonight, 1300 30 34 35 is the number to call, or you can email us super@skynews.com.au. And all callers will receive a free copy of the one-page financial plan. It looks like I might be saving myself a few copies of that this week because it has been mighty quiet. Now, during Lunch Money this week, I was making comments around where the share market might be headed. We might have a bit of a look at that clip, or in fact we might go to that clip right now. Potentially lower interest rates could well push us not only over 6,000 but well into the 6,000s towards 7.
So it seems like we just get close and close and then suddenly something happens and we have to pull back. Sure. What would it take, do you think? Is it central bank action purely domestically, or is it overseas as well?
I think it's a bunch of different things. I think I just came out of an investment committee meeting this morning and we were looking at the potential for resources to take off again on the back of the iron ore price. We've got bank reporting season coming up in early May. That could easily be a catalyst for further and higher prices for banking stocks. But that being said, we're heading into May, and as they say, sell in May and go away. So I suppose we're reticent to go and invest more money into Aussie equities when we're sitting on those 7-year highs. We have taken a bit of money off the table over the past few weeks in IINet, in Rio and a few other stocks, just to have to increase our cash and reduce our benchmarks. 200 points wiped off the share market the following 2 days, so that was good timing, but it did recover today. Liam, we are looking at 7-year highs only last week. How high can the market go?
Look, as long as interest rates are low, and they're looking like they're going to be lower for longer, that will sustain the share market for a long time. But the problem is companies will have to show at some stage that their earnings are growing at the same time. This week you had the rumour that APRA will come out and increase the capital standards for the banks, and suddenly you've got ANZ down 4.4%, Westpac down 3.7%, and CBA down 3.5%. I know people who invested last week. I asked them not to, and they still went in and bought the banks, and they're phoning me this week going, "Oh, you're a guru." I'm going, "I'm not a guru. It's plain common sense. Don't be buying in at the tops."
Do you worry a little bit when you hear 7-year high?
Yes, because on average, every 7 years we see some sort of glitch come up. So
yeah, it's been fairly consistent.
But at the moment, there are places you can hide. I still think you can hide with some international exposure because the Aussie, if anything does happen, the Aussie dollar is going south. So that may provide.
It did go north last week, which is probably why IOO, which is the top 100, and I've espoused this ETF many times before. We actually sold it. We sold it about 2 weeks ago. It was the worst performer this week, which is interesting on the rising dollar, which is probably why we're more likely to see interest rates go down next week. So, Effie, what do you reckon about this?
Yeah, the dollar did go up last week, wasn't it? It was quite strong, and they were suggesting that it's going to have a little run like that, buy up if you wanted to go overseas.
Iron ore price went up, and interest rates looked like they were staying stable.
But essentially, I agree with Liam. It's at a time when you have a look at a lot of fund managers too. They are changing their distribution in assets, and a lot more is going into their cash reserves. So that's always an indication as to what the top end of town is doing or thinking.
Absolutely.
It's looking for buying opportunities. I'm telling clients, yes, cash is paying nothing at the moment, but if the market does drop another 200 points, that's a beautiful time to get in. And because we know interest rates are going to stay low, the markets will move forward in the short to medium term.
And it does depend what is your need. So the bank stocks are still probably it's better to have if you've got them a better return than putting it into the bank, of course, with your dividends, your franking credits, and so on. But would I go now and buy some bank shares? No. And there is a lot of value overseas in bank stocks too, maybe if you are looking for it.
Absolutely. Now we've got a caller on the line, Michael from Sydney. G'day, Michael. Welcome to the show. What's your question tonight?
G'day, Sam. And first of all, enjoy your show. Quick question with regards to the bringing forward rule on superannuation. If one's paid previously the $150,000 as it was for 3 years, and it's now gone to $180,000, can one top up at this stage before the end of this financial year?
That's a good question. Michael, no is the quick answer. So if you've exceeded $150,000 in a previous year, that triggers the bring forward rule as of that particular year, so you can't actually implement the difference between the $180,000 and the $150,000. Liam, do you have a different view on that? What are your thoughts?
I don't have any earpiece at the moment, so I didn't hear the question.
Oh, apologies. Well, the question was, with the bring forward rule, if you put in the $150,000, can you now make up the difference given the fact that it's moved from $150,000 to $180,000?
No, you can't. No. It was at the time you triggered the actual rule. So anybody who's in that case was on the $450,000 maximum.
Yep.
Anybody now, it's the $540,000.
Yeah, exactly. So you're going to have to wait another year or two. Hopefully it's not too long for you, Michael, but unfortunately no choices there. If you did the $450,000 or anything over $150,000, it does trigger that $450,000 rule. So not much you can do there. Now we are going to go straight to a viewer email. Dee writes, I'm a 50-year-old woman and was a housewife raising a large family. My husband was self-employed and earning lots of money. After leaving, I now have no super. I'm thinking about buying shares with good dividends and franking credits and just leaving them until I retire. For example, Telstra and the 4 major banks. What is your view? Well, I think we gave you our view a few moments ago on the banks. But listen, I love Telstra and the 4 major banks. I have all 4 major banks in the portfolios at Henderson Maxwell and Telstra. In fact, Telstra is one of our largest holdings, and it has been for quite some time because of those large dividends. That being said, we topped down on ANZ last week, and we did sell down a little bit of NAB as well. That being said, I think these dips that we're getting at the moment are going to be fairly shallow, and those shallow dips are going to provide buying opportunities. For the long term, yes, I would be buying these 5 shares, but I wouldn't be buying just these 5 shares. I'd be diversifying. I'd certainly be looking at some ETFs to get some diversity, and possibly some overseas ETFs, exchange-traded funds, to give you the sort of diversity that you need in your portfolio. Our interest rates are still on the down, which is a positive thing for international shares, purely on the basis basis of the Aussie dollar, and I think that situation is likely to continue, and we are seeing a slight rise in US rates at the moment. That being said, they're not going to go and shoot the lights out anytime soon. Liam, your view?
Mate, you summed it up perfectly. What you've got to remember is that you buy the 4 banks, they go in cycles. They may all fall at the same time. You can't just put all your eggs in one basket. So really, I love ETFs for getting that core diversity and spread across the world. And look, you can even get international funds now that focus on income as well. So, you know, and look at putting some of that money into super as well. Use the system, use the strategies before you look at the investments. They can often add a lot more than the investments themselves can.
Yeah, absolutely. Superannuation is such a terrific method of investing, but you've just got to make sure you can get access to the money even when you need it. I think that's one of the keys. Effie?
Assuming you come into a bit of money, the first thing I would be doing is don't do anything rash straight away. Do get some advice and go to a fee-for-service financial advisor, and do spread your investments. And echo the same sentiments as what you were saying with the bank shares. Yeah.
Now, Haley's situation's not an uncommon one at the moment. A lot of divorces, a lot of women out there now investing for the first time in their lives. You know, she was staying home looking after kids, raising a family, and here she is now expecting to make investment decisions either in superannuation, which is a very complex system. What's your advice to someone in that situation?
I'm seeing a lot of that too, and I think Victoria had that statistic before early on in the show whereby 1 in 2 marriages, it's ending in divorce. It's not the 7-year itch. It is when we are probably in our 40s, 50 or so on after, I like it to say, you turn around, I think I've said this before, and go, who are you? Because the kids are gone, the conversations run out.
They reckon the over 50s is the fastest growing divorce age bracket.
And that means that as a woman, if you have not had financial control, then you enter an area where it is very complicated, and you can lose whatever money is coming your way very fast. And there's a lot of catching up to do too, because 50 is still young. When you look at the average age, you know, you expect another 30 years. Now, in an investment, at least, yes, of course, you can take some risks in your asset allocation. You just don't leave it and sit it there. So it's not too late to make money in 50s, and that's where most of us are making our money.
So buy Money magazine.
Well, that would be a good
get
start.
Educated.
And I believe, without being, in the tax department, it's tax deductible if you've got some investments. But do seek independent advice on that.
Education is the key.
It is.
It's all about education. Now, unfortunately, viewers, that's all we have time for tonight. Thanks so much for helping your fellow viewers understand superannuation and retirement a little bit better with your wonderful questions. A big thank you to my experts tonight, Effie Zaras, editor of Money magazine, and Liam Shorte, director at Shorte Financial Planning. And a special thanks to Victoria Mills for joining us today, talking about small businesses, which are so important to our great nation. Now, my name's Sam Henderson, CEO and Senior Advisor at Henderson Maxwell, and if you're looking for financial advice, we'd love to hear from you. And if you're looking for some tips and ideas, you can sign up to our free e-newsletter or our blog at hendersonmaxwell.com.au. Thanks again for your company tonight. Remember, there's never a silly question when it comes to your own money. Good night, Australia, and have a great weekend.
The information featured in this program is general in nature and therefore should not be relied upon. Guests appearing on the program may have commercial arrangements with some of the companies mentioned. Before making any investment, insurance or financial planning decisions, you should consult a licensed professional who can advise whether your decision is appropriate for you.